Right, hi, Ashley Banfield here, Wealth and Success Academy. You've seen videos of me before. If you haven't, I help people invest in property, whether it be rent to rents, doing flips, etc., etc., etc. And I also help my students who have now become financially free to take it to the next step and learn about how to manage their money and plan for their future. We don't teach any get-rich schemes here. What we teach is none of it's get rich. So if you want to get rich quick, tally ho, time to switch off and go and look at some other crap, right? This is about long-term wealth, building long-term sustainable wealth so that you can retire in abundance, but also enjoy the abundance now. We don't want to wait until we retire to enjoy money or to have money. Or wealth being connected to that, obviously. So let's get started. So we are Wealth and Success Academy. We've been around now for, 7-8 years. We've been teaching people for that time. I've been in the UK for 17 years now, investing in property for 15 of that. And amongst other things, I've got 7 different businesses. So I've got a little bit of experience to be able to share with you. So let's crack on. Okay, you can see our website there on screen. Just go to wealthandsuccessacademy.com if you want to learn more or get in contact with us directly. So what is today about? Today is about money and why you should not save for the future. Let me say that again. Why you should not save for the future. Yes, I know it's against what the government principles and criteria is to tell you must save. So let's get into it and find out why and what your options are. There will be some stuff here that surprises you. You may think you've missed the boat. Nobody's missed the boat. Doesn't matter how old you are. You'll see that 1 year can make a massive difference to your future wealth. So money. Ask yourself this. And you can, because you're watching the video, you can stop, pause, and I suggest that you write this down. Write stuff down as you go along. So if you need to pause now, pause, go and get a pen and paper and go and write it down and take notes, because you may want to share this with your partner, your spouse, your friend, your cousin, uncle, auntie, brother, because I can assure you this will help every single person that you share it with. Whether you share this video or share the information, it's up to you. So what is your current knowledge and experience of money? What have you been taught? No matter what age you are, if you've chosen not to make your own connection, if you like, with money, then you are simply doing what you've been taught from a young age. Now, you are taught money from the day you were born, whether you know it or not. My kids are 9 and almost 9 in November, I think that William is, and then my daughter is 7. We constantly talk about money. Whether it's, Dad, can I have some sweets? Can I have this? Well, okay, what is it going to cost me? How much time do you think it takes me to earn money to be able to pay for that? And by the way, how much have you got? Blah, blah, blah. Not in a nasty way, in a way to educate them. And I want them to be taught the knowledge of money, in that money is your friend, not your enemy. If you're watching this and you're finding it hard to pay bills, because you don't have enough money, money is considered in your head your enemy. Money is not good. Money is too tight to mention, too hard. Money is made round to go round. All these sort of things, right? Think of all the bad things that you've been told, about money. Money doesn't grow on trees, Well, that's a fact. It doesn't grow on trees, so it's probably factual, but it's said in a negative basis. So I want you to now start thinking positively about money. Whether you're 15 years old, your kids are 10, your kids are born, or you're expecting a baby, or you're planning to have children, all of this is relevant. If you're 60 years old or 65 years old or even older, this is still relevant for you now, because if you are able-bodied, you are able to do something here and make a difference for the rest of your life. Now, you've probably been taught that you should put a little bit away for a rainy day. Another one of those sayings, right? When does it ever rain? Well, if you don't have money, it feels like it's raining every single day. Investors will pounce on investments when everybody else thinks it's a rainy day. Buy low, sell high. When the sun shines, we'll sell the stock because everyone's happy, because their experience of money is now that we've got more money in our stocks or property or in our bank. We've just been paid. We're happy. Think about payday. I own a hotel and a pub as well, and I know when people get paid because that's our best weekend. Now, what are those people doing? They're happy and they're spending. However, in many cases, they're spending money that they don't have. Oh, Mr. Landlord, the rent's going to be late this month. I haven't been paid yet. I've got to be paid, or, I can't pay the electric. You're getting those red letters through the door, so on and so forth. Well, now is the time to change your experience of money. I'm going to teach you a lot about money over the next half an hour or so. Every single thing that I give you is to teach you and to help you. We are selling zero here. This is to help you. This is stuff that I've been taught over the years. This is stuff that we do now. This is stuff that friends of mine do. Many multi-millionaires. One billionaire that I know that I can pick up the phone to. This, you're going to get a taste of the mentality and the knowledge and experience that we have of money. Good? Now, another quote, if you like. You can take it as a positive or a negative. At the end of the day, our graves will be the same size. Absolutely. There ain't a lot you can do when you're dead, whether you believe in reincarnation, going to heaven, whatever it is, or you just rot in the ground. At the end of the day, when we are buried, if you are buried or not cremated, whatever it is, the saying is the graves will be the same. In other words, as the guy there on the bike, the guy in the Lamborghini, it's a £250,000 car. It could be a 50-pound, 250-pound bike. They're very, very different. It doesn't mean to say that the person on the bike is not financially free and very happy with his life and could have multi-million pounds worth of investments. The fact that the guy's in the Lamborghini, he likes to show it off. So what I'm trying to say here is, don't assume. I wear t-shirts and shorts all day, every day, from like April until October, if I can, depending on the weather in England. However, from there on in, I might wear chinos or jeans and still a t-shirt, but maybe, I don't know, a gilet or a jumper over it. And I'm always in trainers. Always in trainers. I very rarely dress for anything formal, because that's what I'm happy with. I have to impress no one. Pretty much like the guy on the bike. Now, the other assumption is there's a rich guy there, there's a broke guy there. Hey, I don't care about you driving your Lamborghini because we're all going to die the same. You can't take it with you. That is a fact. However, it does not mean that you cannot enjoy your life while you are alive. I want you to be able to create choices. The choice to do what you want, when you want, with whoever you want, buy what you want, prove nothing to no one. I want you to have that true financial independence where you rely on nobody at all. You choose to mix with the people that you choose to mix with. You choose to give certain things your time. Time is what we need. We need to get more of our time back. And to do that, we need to take away more of the mundane crap of a daily basis. And sadly, money, investments, etc., on this planet, in this day and age, you most likely need in most cases. So let's show you how to do that. Some quotes about money. Too many people spend money they earned. to buy things they don't want, to impress people they don't like. In some cases, the people in the Lamborghinis, Ferraris, whatever it might be. It may be that they have a true love for a Lamborghini. It's something they dreamed about. They had a poster on the wall when they were 5, 6 years old. They've achieved that goal. Fantastic. Money often costs too much. Costs what? Does it cost time or does it cost more money? Is a mortgage going to be expensive if it's 10%? It's going to cost too much, and I'll show you why. Are you getting 1% return for your savings, but a mortgage is costing you 3 or 4%? Are you getting 1% for your money, but your fees on your bank account over the next year are costing you roughly 2 or 3%? Are you spending money on a credit card which is costing you 20, 25% per annum? Money often costs too much. We need to make money earn its keep with us. If I want to have money here, that money has to go out for work. Sitting in your bank account, your money is sitting there idle, unemployed, doing nothing, waiting for a job. And the only person who can give it a job is you, the person who holds that money. An investment in knowledge pays the best interest. Benjamin Franklin, if you haven't heard of him, look him up. He's an American guy. An investment in knowledge pays the best interest. And I'll talk to you about education and also self-education. What the government or the state tells you that you need to learn, and I'll tell you what you should learn. An investment in knowledge pays the best interest. Think about that. You're learning about money here today and where to invest and what to invest in. I'm not just saying, here's 20 quid, here's 50 quid, here's 100 quid, 10 bucks, 20 bucks, whatever it is. Do what you want with it. That's teaching no one to fish. I will tell you the secret to getting rich on Wall Street or the FTSE 100, whatever it might be. You try to be greedy when others are fearful, and you try to be fearful when others are greedy. Sell high, buy low. It's a very simple statement. Warren Buffett, one of the most prolific investors of stocks and equities in the world, and the most successful. Charles Dickens once said, an annual income of £20 with an annual expenditure of 19.6, old money terms, under £20, results in happiness. Yes, it means you're not going to be in debt. Annual income £20, annual expenditure £20 ought and 6, whatever that is, results in misery. In other words, you're spending more than what you earn. And how we got to this in this wonderful world that we are in 2021 is mostly by easy finance, such as credit cards or store cards, which have extortionate interest rates, and also payday loans and those type of things where people get in much more trouble. There should be more education on this for sure. However, it gets you in a lot of trouble because they call it like the magpie. You see a shiny thing and you want it, and you're gonna buy it no matter what, because somebody else over there's got it, or someone in social media's got it, and you want the big high top trainers, you want the new groovy shoes or whatever it might be. You are looking at others to try, like it says at the top, you're spending money you earn on things that you don't want to impress people that you don't like, or on social media, if you've got 1 million followers, probably you might know 10 or 20 or even 100. But the rest of that many, you don't even know who you are, and you're trying to impress them. You know, the selfies, the photos, this, that. How much time do you spend doing selfies, this, that? Oh, look at my shoes. Look at me, I'm a dude on the street. I'm out dancing, I'm eating food. Look at my food. No one really cares, but you think it does because at the time it feels good to do it. Never attempt to make money on the stock market. This is another Warren Buffett. I never attempt to make money on the stock market. This is one of the most prolific stock traders on the planet. I buy on the assumption that they could close the market the next day and not reopen it for 10 years. Meaning long term. Because even if it does close for 10 years and opens up in 10 years, you've still got your money. You only lose when you sell. Housing market goes up, suddenly it crashes. If it crashes and you sell based on temporary news, you will lose money. However, if you are patient and wait for the return, even if it's 2-3 years, you'll have your money back, and then some on the recovery. You don't want to be selling on the way down. You want to be buying on the way down. You cannot pick the bottom. You cannot pick the top, whether it's the housing index, FTSE 100, 250, S&P, whatever it might be, NASDAQ. You cannot pick the top or the bottom. If you did, you wouldn't be sitting here. You'd be a multi-billionaire. Maybe perhaps a trillionaire. Warren Buffett began seriously investing when he was 10 years old. For those who want to learn about helping their kids, listen to all of this in its entirety. Now listen, I'm not telling you to buy stocks. I'm not telling you to buy property. I'm not telling you to buy bonds, gold, silver, copper. I'm not telling you to do anything. What I am trying to do is share what we do and what others do, as I said from the start, so that you can be future-proof monetary-wise. This is an example of a man who started investing when he was 10 years old. Now, if your kids don't have the ability to invest and they are 10, 12, 13 or 3 or 4 on their way to invest, learn how, so that when they are 10, 20, 30 years old, they can be millionaires. And I will show you how that's done. It's up to you what you do with this information. By the time he was 30, he had a net worth of $1 million, or in today's value, adjusted for inflation. I'm going to teach you and tell you what inflation is and how it can make or break you. $9.3 million in today's value. And he's in his mid-80s now, I think. So we're talking 50 years ago. Now, one thing you need to take away from there as well is that $1 million 50 years ago is now worth $9.3 million with inflation being added. That's huge. And you're going to need to learn and listen about this as we go through it, because you need to 100% think about inflation before you invest in anything. Now, another thing here that will come up. He has what we call diversity in his investments. However, his diversity is limited to maybe 12 companies or so. I don't know if Warren Buffett invests in property. I don't know. I know for a fact he still lives in the house that he lived in many, many years ago, decades, and still drives the same Oldsmobile. He has no interest in wasting money on big flash houses where only one person can live, or 2 people, whoever he lives with. And he's not interested in buying flash cars when that car will do what it needs to do. And I'll show you why that makes sense and why you need to understand that moving forward. Now, Apple, you can see that he bought in, his investment was to a value of 35 billion. This is a company now, I think, is still worth over $1 trillion. That's 1,000 billion US dollars. So he hasn't bought a huge amount in comparison to the total value of the company. So he had stock that he bought to a value of 35 billion US dollars. This could be 35 pounds. It doesn't matter. Add a zero, it could be, 350 pounds. Look at the value now. Let's say it's worth 730 pounds. You might have put in £3,500. It's now worth 7,300 pounds. The fact is, you're making money that you've put into an investment, which is a company that you're investing in, without being a director, without having to do anything, without having to design any new Apple products, without having to sell them. You're doing zero. You're passively earning income, because you will also earn a dividend as well that's paid to you on a monthly or mostly quarterly basis. Now, I'll show you that if you reinvest that dividend back into the stocks with compound interest, the value of your stock is going to go through the roof, whether you do that with stocks, shares, or property. So he's now worth 73 billion just in that company. Bank of America, 12 to 33. Coca Cola, 1 to 22. A lot of people sold shares in Coca Cola because of one report, which is temporary news, and we're going to come across temporary news, that said that the earnings are down. Whoa, the stock went down flying. People sold. Let's get out, let's get out, let's get out. Mum and dad investors don't think long term. Short term, short term. He stayed in. What is he worth? Imagine that was £1,000. It's now worth £22,000. Wells Fargo. These are all American companies. Pretty much. So he knows and invests in what he likes and what he's interested in. And you should do the same. There's no point investing in a company that makes keyboards, for instance. If you have no interest in keyboards, you don't want to read anything about keyboards. Find something you're interested in, you're passionate about, and invest in that, even if it's stocks. Invest in it. Put your money away. Don't put the £100 extra away per month into a little secret bank account or £200. It's going to earn you zip. It may cost you to put it in there with fees and with tax, etc. Unless you're putting an ISA, you might be lucky to get 2%. When inflation averages, anywhere between 2, 5, 6, 7, 8% over the decades, you're going to be losing money. Let me get into that now. Formal education. This is education. You've been to school, you've done your education. The government has said this is the criteria, this is what everyone must learn, and this is how you must learn. Whether you go to state school, private school, or whatever, there's just a different spin on how it's done, and la-ti-da, or all right, son. You can get trapped in the cycle. What is being trapped in the cycle? What is the cycle? The cycle is son, daughter, boy, girl, go to school, do your homework, get good grades, and get a trade. Something you can fall back on. Fall back on? Well, what's going to happen? What's going to happen what am I going to do that I need a trade to fall back on? Can you tell me that? Well, you never know what's going to happen, mate. Yeah, but what's going to happen? Well, you never know. Ah, right. So you don't know it. No, I don't know. So get a trade just in case. Or go to uni. Get a degree. Get yourself something to fall back on. You'll always have that. You'll always have your degree. You'll always have your trade. You can always go back to that. From what? If I'm going to be a plumber, I want to be a plumber. Why do I have to fall back on plumbing? If I want to be a lawyer, why do I fall back on it? What am I going to do? I don't know, son. I don't know, but just get something to back you up. Right. Thanks for the advice. Again, knowledge and what you've been taught from a young age about good, bad things about money, job, following the rules and that type of thing. I'm not saying break the rules. But you go to school. Then you either go and get a trade, or you might go and do sales. I don't know. You might go and do a uni degree. You might have your fun for 2, 3, 4, 5, 6 years. You might spend the rest of your life getting PhD until they're coming out your bloody backside. It's up to you. You might get a degree, and in most cases, I think it's something like 40% of all people who go to uni, it might even be more, look it up, in the UK or even the US or wherever you are, or Australia, look at the percentage of people that get a degree and how many of them actually go out and do that job that they studied. So they might have studied marketing. How many actually do marketing? They might have studied IT. How many are doing IT? I can tell you, I know lots of people who've studied all sorts of things at university and they're now in sales because they're hungry for the money. But what they're doing is they're spending that money quicker than they can bloody earn it. Hence the previous quote. So be careful about getting trapped in that cycle. You need formal education to a certain extent. But formal education, as it says there, such as school and university, are fantastic for helping you get to a stage to make a living. In the UK, they want to see that you've done your your high school. They want to see you've done O levels or A levels or university. They'll even specify degree preferred or whatever it might be. You know, 1-1, 2-2-1 or whatever it is. We want top scores. It will get you a job. But it won't necessarily make you wealthy. Limited by the government's criteria. What they want you to know, what they think you need to know. I don't know anyone in school who's been taught any of what I'm going to tell you here today. You're not really taught about money. You're taught maths, you're not really taught about money. When I help my kids with their homework, I talk, and when we do play Monopoly, I talk to them in monetary terms and investment terms and why you should buy this and why you shouldn't buy that and where you should go here. They beat me at Monopoly every time, so maybe I'll get my kids on here. They seriously beat me at Monopoly every time. Haven't beaten them yet. Remember, they're 9 and 7. Get a job, pay your taxes, save for retirement, be a good citizen. Ask yourself, why does the government want me to... And I'm not anti-government, believe me. I'm not anti anything. I'm not a conspiracy theorist by any means. I work on reality and fact. Why do you think they want you to get a job? It says it there. Pay your taxes. They want you earning because they don't want you to be a liability on the state, as in unemployed. They want you to work so you can pay taxes. Pay them taxes. They don't want to be paying you their taxes. Must work. Go out and get that minimal education so that you can do the minimum work required. How much of your wage do you think you actually retain? Probably 25-30%, maybe, after you've paid income tax, VAT or whatever tax it is in your country, sales tax, all the other taxes, the business rates, which is, you know, the company that's selling to you, the taxes that company pays that's selling to you. All this is taken into account. And whatever's left, your 25-30%, whatever it is, you get to go out and spend, and guess what? You then lose it all by getting taxed at death. The government wants you to be a good citizen, to pay your taxes when and where you should. Make sense? We don't want to do that. We want to self-educate ourselves, much like you're doing here right now, on perhaps a better way. Choices is what I'm going to help you with today. Formal education will make you a living. Self-education will make you a fortune. Jim Rohn. Look him up. Another statement. Take it either way you want. He is rich or poor according to what he is, not according to what he has. What he is. Are you a blubbering mess who can't afford anything and blames everyone but yourself? Or are you a successful, positive-minded person who will do whatever it takes to help yourself and others around you, whether it be your family, friends, or whoever it might be? I don't look at people and say, wow, he must be successful. He's driving a Lamborghini. I say to myself, I wonder what they do. I wonder how they get to the stage of being able to waste money on a Lamborghini. And I'll show you why it's wasted later. Hey, look, you get to a certain level, you have a certain amount of money. You know, you can buy your toys, you can play around, you have your holidays. Holidays, there's no return on investment. Cars, there's no return on investment unless you're obviously buying cars that do increase in value, vintage cars or rare cars or something like that. So he is rich or she is rich according to what he or she is, not according to what they have. Make sense? Sadly, once again, I'm not saying that money makes you better. It doesn't. It can make you worse. Look at lotto winners. You know, a lot of the lotto winners, and I researched them and I've read about them. One recently died in Scotland. I think she inherited, not inherited, she won something like 20 odd million, gave a little bit away, and said it was the cause of her stress and her death. It will kill me. It's the worst day of my life when I won lotto. People begging, knocking on the door, oh, I need money, I need money. Abusing you for not giving them money. Now, I can tell you now that there's not a lot of people out there who the equivalent money have people knocking on the door and sending them hate letters. Where's my money? I want money, blah, 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 blah. Because there's a different mentality that if you've won it, you never had it, you can give it away. However, people think if you've earned it, according to what he is, not what he has, then there's a different mindset to what people have. You know, you'll talk about people, oh, he's done well, but I tell you what, he's a hard worker. Has he worked? Nobody works harder than him. He deserves everything he gets. Or, that didn't work. He inherited it. Yeah, he took it all. Only person who was in the world. Blah, blah, blah. See the difference? You know, you probably thought about people yourself. Is this a statement that you would say to me? If I said to you, hey, you know, don't pay your mortgage off, use the money. But I'm happy saving for that rainy day. And I'm happy paying off my mortgage as quick as I can. In fact, I'm quite proud. I just got a £10,000 bonus. I put it straight on my mortgage. Straight on my mortgage. And you know what? I reduced it by a year. In some cases, it could be 3 or 4 months. In some cases, it could be 2 years. Depends on the value of the mortgage. I'm happy with that. How long is your mortgage? 25 years? 24 now. 24 years. I tell you what, if I win 100 grand tomorrow, it's going straight on the mortgage. I'll only have 10 years left then. 10 years. 10 years. And the mortgage is paid off. And I'm happy and I'm free. I'm free from the shackles of debt. Bollocks. So do you put all your spare cash into paying your mortgage off? The house that you live in. Think about this. So I live in my house, right? My own house. In other words, I don't rent. And we have a mortgage on it. Because much like a car, you don't know if you're going to live in this house forever. Much like you're not going to have a car forever. So why put your next 25 years of your life into paying, you know, sorry, not the next 25 years. Why spend the next 25 years or less trying to put every single penny into it? Because at the end of it, you're going to have a house that's worth a certain value. You're going to live in it. You're going to do nothing with it. So basically, it's like having, if it's worth 250 grand or $500,000, it's like having that money sat in the bank doing nothing. Unemployed capital. Repeat that. Unemployed capital. Oh, but I feel safe. I don't owe anyone anything. That's right. But when you retire, what have you got? Your pension. You might get 20, 30 grand a year. Maybe. Maybe. What's that going to buy you? Oh, I can sit in my house and enjoy my garden. I don't need to travel. I don't need to go anywhere. I don't need anyone or anything. I'm free of the shackles of debt. And I've heard it all. I've heard it from many people. And they also sit there and they say to themselves, well, you're doing all right, aren't you? New car, new this, new that. I've heard you bought another house, 2 more. The businesses are going well. Bought another business. I see you bought the building in the business. You're doing all right, aren't you? Well, yes, and you might do too if you're employed. You're £500,000 in your house, or even half of it. We work on 50%. You don't want to own any more than 50% of any property that you have. The other 50% should be used to generate more value, more equity, more capital, more cash flow. 50%. Or are you just trying to save for your kids' education? Which many people I know do. You're earning your money. You're putting your extra £200 a month into your mortgage just to pay it off quickly. The shackles of debt. And my kids. Oh yeah, my kids. I want them to go through uni because formal education, something to fall back on. Got to go through uni, and there's nothing wrong with that. It's good. However, you do not have to save for the education. £200 on the mortgage, £200 on the kids. £400, that leaves me a couple of £100 left over. Take the missus out once a month. Or the husband, or whatever, or the girlfriend, boy, you know what I mean, right? You get the picture. Shit. What a life you're living. I'm doing it for the kids. I'm sure if your kids are watching me now, your kids would say, guys, listen to the next bit. I don't want you sacrificing your quality of life now for me. Learn what he's going to tell you next, because there's a different way and an easier way. Don't sacrifice your quality of life. And there may be other things you save for. I don't know, jet ski, motorbike, holiday, Christmas fund, whatever it might be. Let's put a tenner in there, 20 in there, 30 in there. There's nothing wrong with that. It's how you've been taught. Like I said, I'm giving you choices. You don't have to do what I say. Will any of those give you extra cash flow? No, it takes it away. Will it increase your end pension? No, it takes it away. Do you have a pension? Most people don't. I live off the state. That's why I want to pay my house off, and I owe nothing. Well, guess what? You might get sick at the end of your life and spend 5 years in a care home, whether you like it or not. Beep, 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 beep. Your property's gone. Oh yeah, but I paid for it. What a mentality. Will it give you enough at the end of your life? What do you want at the end of your life? What do you want money at the end of your life for? At the end of your life, I'm talking your last days. You want money now to enjoy life. I'm sure, whether you believe in God or not, God didn't, create the world and say, right, humans, I'm going to make sure that every one of you suffer until you retire. Only when you retire, and I might make it that you die on average of 75, because I'm going to give you cigarettes, alcohol, and all this sort of stuff, just to speed up your death process. So I'm only going to give you 5 or 10 years maximum after that to spend all the money that you've, your mortgage. I'm going to give you 10 years to spend all that. Maybe 10, maybe 5. Maybe. And then he says, oh, by the way, when you do die, I'm going to get them to take your money anyway. Death tax. Death and taxes. I'm sure, if I was God, I wouldn't create the world like that. We've created this. We've done this. But there's a better way. When is enough enough? Oh, yeah, I'm all right with me. I'm all right with it. I can survive on £200 a month. Frick! I'm going to swear. Stuff surviving. You can survive in the middle of a desert. If you think, I just want to survive, that's enough for me to survive. Too right, mate. Is that really enough? Do you want to survive or thrive? I'm 50 years old now. When I'm 60 years old, I want to still be investing, thriving more than I ever have. Because I know that my investments will grow in value and I can keep investing. Do not think that you need enough until the day you die. That is called your investment horizon, which is a nice way of putting to the day I die. Do not plan for your investment horizon. You need to plan beyond this. However, one size doesn't fit all. There could be, you could have historical health issues in your family, and that everyone lives until they're 60 or 65, whatever it is. Do not plan to that. You may live until you're 80. plan beyond that. Write a will to what's going to happen to it, to the rest when you're gone. You don't care what happens to it when you're gone. You're gone. Remember at the start, can't take it with you. What do you need money for? You can't take it with you. No, I want it now. To help others, to help myself, and to leave a legacy for my family. Help your kids. Imagine if your parents had helped you, if you haven't been helped. And, you know, they got you a house, and then even if they just bought you a house, or bought you some shares, put in £100 a month into maybe just a simple index fund that's now growing thousands of percent, is now worth, you know, £600,000. Will that help them get their education, etc., etc., etc. underway? Damn straight. I'm going to show you calculations on how we do that. What age will you leave this planet? You don't know. You don't know. How much will you need? You're assuming this is how much you need based on the current marketplace inflation rates, etc., etc., etc. What happens if when you retire, inflation goes up quickly, 8-10% because of some economic issue? Then what? You don't understand inflation yet, but you're soon going to find out. How much do you need each year? Oh, 20,000 a year. Well, hang on a minute. You're 50 now. In 20 years' time, what's that 20 grand going to be worth? Zip. Not a lot. How much each month? How much each week? Wow, what about the cost of living increasing? Shit, man, that's eroded. It's gone. Oh, I thought 20 grand would be enough. Because your mentality is now. It's temporary mentality. You must have long-term mentality when planning for investments and planning for your life. Not just in the future, now, meaning now and next year. What you do now makes a difference next year. Compounding, you're going to learn about it. You will need to budget if you decide on one lump sum. I'll pay my house off, I'm going to use that $500,000. Oh, I've been saving all my life, you know, just putting a little bit away. He doesn't know about it. She doesn't know about it. But I'll tell you what, when we retire, I'm going to surprise them. 50 grand I've got in there. 50 grand I've saved up, put away. Put that away, I have. I'm going to keep going too. Put an extra 50 quid a month in next year. We'll be there. And I should have about 65, 70 grand in my little nest egg when we retire. We'll want for nothing. Yeah, if you live 2 years or 3 years, you'll want for nothing. What about if you live 20? Bloody heck. Inflation. The old mate, inflation. You must plan for inflation whenever investing, thinking about retirement or whatever it might be. You must think about inflation for next year, for the year after that, every single year from now on in. Whether you're thinking about your unborn child in the womb, ready to burst in the next few months, plan now. And plan for the first year of their birth and the last year that you think would be assumpted by the average age of 80 years old or whatever it might be. Plan now. Look, maintaining purchasing power with an assumed 4% inflation rate. It goes up and down, up and down. And this is an inflation rate between 1915 and 2018. It's an average of it. £500,000 in year one, in 31 years, could be worth 1.6 million based on 4%. Now, that's if you're investing. If you have a 4% return, compounding I don't think is taken into account here. However, think of it this way. What you can buy now for £500,000 in 31 years is going to cost you £1.113 million more. It's going to go up from $500,000 to 1.6 million. Now look, let's do 6 years. Short term, it's going to cost you an extra £107,000 for the same thing. 11 years, an extra £238,000. And you think you've got enough now to cover yourself in me retirement. Allow for the increases in the cost of living. If something costs you £1 now, it's going to cost you £3 or £4 in years to come. Think about a pint of milk, a loaf of bread, the staples of the diet in the UK. So not only is, your savings going to get eroded by the deflation of what your pound will buy you, but your savings are going to come down as well, and you're going to get taxed on a certain percentage above any withdrawals. Your purchasing power will decrease, and I mean decrease substantially, if we rely on one lump sum of money. I've got me 75, it's got to be 75 grand. It will decrease substantially without growing, because if let's think of it like this, if you're putting £100 away a week and you're saving that for the next, and in 20 years time you're going to call on that £100 all of a sudden in 10 years time is more like you're putting in £70. And if you don't increase the amount that you're putting in each week, it's going to go down further. So you think the mentality is, I'm saving money, darling, but you're actually not. You're burning the money in fresh, thin air in that bank account, or you're burning the money in the house. Yes, the value of the house is going up, which is one positive. There is no cash flow because it's you living there. You'd be better off paying off your house, going out, renting a smaller house, a little 2-bed if you're retired or whatever, a bungalow, and then renting out that property and collecting 500, 600 quid a month or more. Yes, even that small thing can give you income. And it will probably be more income than what you get from saving your 75 grand for 20 years. I do get passionate about this because I see the majority of people out there wasting their time, efforts and money, putting money in the bank that's actually decreasing. What do you think the bank is doing with the money that you put in the bank? Well, I have some of that and I will invest it, or I will sell it back to you by way of a loan and a mortgage. Oh, thank you, dear customer, said the bank manager, for funding my lifestyle. We will be forever grateful. Forever, mortgage, till death, mort, Latin. We will be forever grateful. Well, until you die, forever grateful for your contributions. Thank you so much. I told you some of this will piss you off. It's easy to stay the same, but it's not easy to change. Some of you will watch this. Some may have even switched off already because that dickhead, he doesn't know anything. I'm a saver. I'm a mortgage payer. Most people choose to stay the same all our lives. If I can change just you watching this now, just you, I'm a happy man. I'm a happy man because I know that one person changed, it will snowball onto your kids, your family, your friends. Oh, so Bruce, what did you do differently? Let me tell you. It might not be for you, but let me tell you. By the way, it's what the top sort of 1%, 0.5% of people in the entire population of the globe, over 7 billion now, whatever it is, they do. This is the reason why the rich get richer and the poor get poorer. Think about that. You're saving your money. It's decreasing in value because of inflation. You can't buy as much with that money as what you did 10 years ago. So you're actually going this curve, everything's down. It's a freaking roller coaster. But you think because of what you've been taught in school, in this formal education, that you must do what you're told. They don't anywhere, in any books, anywhere, say that that is what you have to do. That is the law. No. Shit. Come on. That's Robert Kiyosaki. Rich Man, Poor Man book. Read it. Timing. When to invest. You cannot time the markets. Property, shares, stocks, bonds, or the latest trends, coin, Bitcoin, or whatever it might be. Probably one of the most volatile things on the planet. You cannot time the markets. So I tell you this. Think long term. Buy shares like you will never sell them. Buy property like you will never sell it. It is there for life to give you a return on dividends or cash flow rents, whether that be commercial property, residential property. Remember to invest in companies when you're buying stocks that you're interested in, that you like. Retail, is it something I would invest in right now? Well, all the media saying the high street's freaking dead. That doesn't mean to say don't invest in retail. It means don't invest in retail companies that only have a physical presence. They may have an online presence that's gone like that. Study it a little, find out something you're interested in. If you love freaking rockets, think about, look at Virgin Galactica or whatever it is. If you're interested in electric cars, look at Tesla. Look at the share price. Absolutely mental. Think about it. Don't try to avoid the lows by selling. Remember, Coca Cola give out one market event notification that future earnings are looking to be down. Get me out of here. Because the short termers, the get rich quick knobheads, have lost their money. Save our souls, SOS. However, those who stayed and thought long term never going to sell, such as Warren Buffett, went from 1 billion to 22 billion, £1,000 to £22,000. Your investment of £1,000 may have dipped to £600 or £700. You don't care. You only care if you sell it and make a loss. Wait. Let it run. Coca Cola will be there forever in a day. It's the most used mixture on the planet. Probably the most drank soft drink, soda, whatever you want to call it. Certainly the number one cola worldwide. Everyone recognizes the brand. I'm not saying you invest in Coca Cola. You may not like Coca Cola. I'm just giving you examples. Think long term. At the moment, there's a bit of a property boom because of, people wanting to move out of cities. The stamp duty holiday is now finished, but all of that has inspired people to buy. And as the market's got people, I want some of that. But then there will be a correction. Most probably, I don't know. There hasn't been a real, proper, really good increase since the property crash in 2007. Not bought on by property, bought on by financial institutions offering 0% deposits and that type of thing. Property wasn't the blame. It's us that were to blame. So think long term, because if you stay in, much like the Coca-Cola story, or if you don't stay in, you may miss those big ups and positives. If you didn't buy a property a year ago, you've missed this big up. But it shouldn't deter you from buying property. It doesn't matter when you really buy a property, as long as you think long term. Minimum, think 10 years. Minimum 10 years. So you can grow that equity. And as I said, 50%. Use that 50% equity to then, boom, buy again. You can normally get that 50% equity within 5 to 6 years, depending on where you are. Then reinvest. Reinvest it in property, reinvest it in shares, whatever you want to reinvest it in. As long as that investment, that asset, grows in value and returns a cash flow. The cash flow takes care of inflation in most cases. Even 1 year can make a huge difference. So don't think if you're 60, 65, 70 years old, I don't have time. I don't have time. You know? I could be gone next year. Mate, I could be gone now. In 5 minutes I could walk out of here, fall over, crack my head on the bed. Doesn't matter. Plan for decades ahead. How do you think a billionaire? What's a billionaire mindset? They think generations ahead. Generations. Millionaires think about their legacy in most cases, not generations ahead. The poor, or the less fortunate, or with a different mindset, think about today and maybe tomorrow. If I can just get through this next year. If we just get through this month, we'll be okay. If we can get through the next couple of years, I think we'll be alright. Don't think, no, create. Do not act on temporary news. Ooh, hello TV, BBC News. What have we got today? The stock market crashed today on news that an alligator attacked a can of Coke. Oh! Sell! Bitcoin, massive surge today. Up 30%. Buy. You wake up in the morning. What happened to Bitcoin? Well, that's crashed. And the alligator. It wasn't an alligator. That's fake news. Shit, let's check. Oh, mate. I'm broke. Oh, I knew it would happen. Investment's a load of shit anyway. Oh, well, if I can just get through. That was going to be my Christmas money. Oh, I'm going to have to tell the missus. Oh, what am I going to tell the kids? I'm just going to have to work some overtime. Doesn't matter, I'll sort it out. I won't tell the blokes down the pub though. They told me I'd be stupid for doing it. Oh well, onwards and upwards, eh? That's what I say. What my mum used to say and my dad. Shares, property, gold, bonds, coins. Paper wealth. What is paper wealth? It is basically having a piece of paper that says you own 100 stocks or 1,000 stocks in BP, AMP, whatever it is, Apple, Visa, Coca Cola, Pepsi, Schweppes. It's not something that's tangible that you can touch and go, I own this computer, this microphone, this shirt. Can't show your mates. You don't want to walk around with your share certificate. Oh, look what I've got. Woo, you can't rev it. You can't put the roof down. You can't put the windows down. You can't turn the stereo up. You can't... Selfie! You can't Instagram it. People avoid it. But I can tell you, as it says there, that annually, approximately 10.1, 10.2, the equity, stocks, etc., produced a 10% return annually, year on year. This does not include compounding interest, which you'll learn about soon. 10% return on your money every single year. So the stock today is worth 100 Let's say it's worth £10. Next year it's worth 11. Then you add 10% to that 11, because each year it's gone up 10%. And in fact, I'll show you that now, how that works. Let's look at compound interest. So let's say you have £1,000 to put away, to invest. Most people can probably scrounge up £1,000 initially. Let's say, let's for the argument's sake say it's £100. You can find £100. You just don't go out one night of the month on the booze, drop your fags or whatever it is. I don't know. Then each month you're going to add, let's say, £50 a month. That's all. So we're going to say £600 a year. That's all. That's little. That's small. And you're going to do it over 10 years. Your interest rate in your bank, let's say, you've got 2% per annum. 2% return. Could be an ISA or something like that, right? We then calculate that. Now, over 10 years, if you put £600 a month into your bank times 120 months, will give you extra added per year, 50 per month, initial lump sum, 2%, add interest, calculate. Future value will be worth £6,823. Now watch this. Watch this. This is without the interest. It will be worth less than £6,000 or almost £7,000 with the compounding interest. If I add, now we'll go back to stocks and shares. We said 10%, didn't we? 10%. You put this into stocks, you get your return. Look at the value on there and watch what happens. You'll be surprised, because I put that money into stocks. I paid £100 a month, maybe into an index fund or whatever it might be. 3 or 4 different companies. I've split up £25 into each one. Calculate. Wow, that's an extra £4,000, £4,500. The same money invested. Look. Now see how this curve starts to go up, because your interest, you're getting interest on interest on interest on interest. Property, 7.5%. Let's have a look what happens. 9,330. Still way more than investing and just saving your money. Fact is, the real percentage of 1% is probably what you get back from a bank. £6,500 versus 10.7 in stocks or 9.5 on property. Now, with the savings in your bank, because you're only getting 1%, inflation may be 3%. 3%. You're losing 2% on the value of your money. Does it make sense now? So the money that you have in the bank is actually decreasing in value, because there's 2% difference against you because of inflation. You're saving that money for a rainy day, but that rainy day may not come for 10 years. And in 10 years, the rainy day is going to cost you a lot more than what you thought. And currently at the moment, globally, cost of living is going up sharply. utilities, etc., etc., etc. So those people who were saving years ago, and now that they've just retired in the last 2 years, shit, my money's gone down. I don't know if we can afford. I've got to go back and I've got to do a part-time job. You're 65 years old. Maybe you're sitting in a checkout. I don't know. Fair play. If you've got to do that, you've got to do it, and good on you. But I'm trying to help you not do this. Now, if it were £1,000 and you're putting in an extra, 200 a month, 10 years, 1%. Look at the difference. There ain't a lot. 7.5% property. Look, see that curve starting to go up. Now with that curve going up after 5 years, hits 5 years, the curve goes up. It will continue to do the same and it'll go up to here. The curve almost gets straight vertical. So imagine what it's going to look like in 20 years. Let's do 20 years. Not 120. I don't think we're going to live that long. Look at the curve going up. Imagine your kids. You put something in an equity fund, an index, 10%. That's all you put in. You're still only ever putting in £200 a month. You're not changing it. And your child is not even born. You put in that £1,000 when they're born, and when they're 50, because you don't want to work too long. Look at that curve. Look at that curve. And look what it's worth. 3.19 million. Now let's see what that 3.19 million is worth, shall we? In 50 years. So we'll go 2019. What, 2000? Oh, it won't let me do it. So, okay, so let's go 2020. Let's go back to 1970 and see how much that. This is assuming an average inflation of 2.7%. Way! Let's just make sure. 1, 2, 3, 5, 6. Yeah, cool. Have we done an extra zero there? That 3.1. No, it is. Sorry. That 3.19 million. If you continue, in today's money, it's worth 50 million. In 1970, 3.19 million is equivalent today of 50 million. So if they continue to reinvest that money as they continue to go along, will they ever get poor and will the money ever go down? No. Is it a nice little head start? Absolutely. Now, if we said to ourselves, we're going to save from year one, we're going to put in a lump sum of £1,000. Your interest rate is, 1% in the bank. Inflation rate is 3% on average. What age do you want to be a millionaire? Oh, I want to be 50. Amount added to your savings every year. I'm going to put in £200 a month. Calculate. Annual saving required to reach £1 million. After 164 years, your £1 million will be worth 6,770. In other words, they're telling you, if you save £200 a month, put it away for a rainy day, it's going to take you 164 years. Look at inflation. What's it going to be worth? Let's do property. 7.5%. Calculate. Oh, it's only going to take you 48 years to be a millionaire. equity-wise. And you reinvest the equity when you get to 50%, you'll be way in front. Stocks and shares. $39 years. Does that illustrate the difference between saving for my pension or saving for the kids' education, or letting others pay the bills for you? Now, what I mean by that is there are companies out there that you don't need to buy a business. You can invest in a business, in a company, one that you know about, one that you like, one that's out there prolific. The stocks will increase. Get 3-4 companies, because there may be one that dips a bit. I don't know. I can't tell you that. Invest in like a Vanguard or something. A Vanguard's called Vanguard, like Index. Look them up. I'm not selling them, but I just have some personal experience. If you're not willing to pick shares and that, and what they'll do is they'll do like a 70 or 80 or 90% equities or stocks, and then they'll do a little bit on bonds as well. Bonds are only about 5.5%. Government bonds and that type of stuff. You must diversify. You'll also get a dividend from this. Now let me show you what happens if you reinvest your dividends. Let's go back here. And as it says here, okay, so this is here. So dividends not reinvested from 1986. Look. It's worth, I don't know, 50 something grand. 50 grand, let's call it, right? If you reinvest those dividends using the compound interest, remember, interest on interest on interest, money's being made on money, and it goes like that, like that. And remember the curve goes like that, and then whoop, exponential growth. It's worth 4 times more just by reinvesting the dividends back into buying more stock for your kids. Your kid is born on the 1st of January 2022. They will not be in uni for probably 18, 19, 20 years or whatever if they have gap years. How much time is that? Let's work it out. Let's work it out. Let's work on 20 years. 20 years. Their current age, 1. You're going to put in £1,000 on the day they're born. You're just going to get them on a little equity fund or something like that. Your inflation is 3%, so we're allowing for inflation. We're taking that bit out. Right? We don't want to be a millionaire, but what we're going to say is 20 years old. Calculate. $49 years. Oh, here, sorry. 20. Age, do you want to be a millionaire? Okay, 20. We don't want to be, actually, maybe I'll use this other one here. Maybe I'll use this one. Let's use this one. So, your current age, yeah, blah, 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 20. It's almost like I want to go backwards. Let me work this out. 7, 20, calculate. Each year you will need to save 25,000 if you want to be a millionaire in 20 years. With compound interest, all this sort of taking stuff on. You'll need 1.7 million, the equivalent of £1 today in 19 years. So after 19 years, so okay, so whatever money you want to save, if you want to save without putting in stocks, your money, your £1 million, will only be worth 560,000 in 20 years' time, almost half. 20 years, we have $1 million. Let's see if I can work it out and work this one back. This is compound interest. So we're putting in an initial lump sum, number of years. Here we go. Right, this is better. So 20 years. So this is your kids that are about to be born or been born or even been born this year. Let's say you've got kids who are 2 years old. Let's work it out on 18, right? Your annual rate, you're going to do 7.5%. You're going to do the average stock. Interest every year. Wow. Your future value of your initial £1,000 and £200 per month is going to be worth £95,000. Now, £95,000. 95. This is that's not assuming you reinvest the dividends as well. Right, so we've put this, so we're going to go back 2020, we're going to go back 2002, right? 18 years. So your 95 grand with inflation, goods and services, whatever 95,000, you've got 95,000 in 20 years time. It's gonna, the equivalent, whatever's costing you £100,000 now, £95,000 in 20 years time is going to cost you £158,000. However, this calculation took into account inflation. We put inflation at 1%. All right, so you can see you get a lot more for your money. So we'll put inflation at 0. Calculate. So you can see it without... dickhead. It won't allow me to do it. Right? 0.1%. Let's try that. You can see how much your money is going to be worth. All right. You know, here it's working on a million. So your million will be worth slightly less. But on at 3%, you can see your money is only going to be worth £560,000. So substantially less. So make sure that what you're saving takes into account inflation, because you don't want to get 95 grand and work out that it's only worth 40 grand. Is that going to pay for uni in 20 years time? Probably not. So you must take into account, as I said, inflation in everything that you invest in. Gold, 7%. But gold, if you're doing like an index or something like that, or some sort of share fund or investment fund, and you say to them, yeah, I want to invest a bit in gold, or want a bit here, a bit there. For me, I wouldn't invest in gold. People chuck their money in gold when the stock market crashes. It's temporary thinking on temporary news. We're thinking long term, okay? And you might say to yourself, oh, but companies will go broke overnight. Do some research. You know, check the industry. Check what's going on globally. Companies are there, big companies are there to increase their sales annually. They have thousands upon thousands of shareholders that they must please. They must keep the stock level up. Yes, downturns do happen. However, they turn around. Don't believe me, do you? Look. This is the Morgan Stanley, whatever it is, Corporation Index, Worldwide Index, made up of all the indices in the world. FTSE 100, the American, the Italians, the Germans, and so on. All the big stock markets. Now, look here, stocks up until 80s. Remember the 80s? When everyone wanted to be a stockbroker and they're on the phone. Oh, sell, buy. That's when it became trendy, right? This is the equivalent of Bitcoin time on the stocks. 1973 oil crisis, stock market crash, all-time low, blah, blah, blah. But really, did it crash that much? Not really. And then, from sort of 1981, we started to skyrocket. Those long lunches in the 80s. Stock market crash on Black Monday. Look at the crash. Look how quickly it recovered. Look, and look where it went to. It came back here to a similar level, kept going. But this is only over 3, 4, 5, 6 years here. Remember, minimum 10 years. You bought your stocks at the peak of the market in 85. Then they crashed. But you kept them for 10 years. Hey, look at that. What an increase. What an increase. And then the dot-com bubble burst, September 11 attacks. A rapid crash. Two things happened. Two things. Global terrorism, global wars. Dot-com bubble, if you remember what that was. But then look, from 1999, you might have bought your stocks. Sell, sell, sell. Keep them. Because within 5 years, look, we think long term. Financial crisis 2017. It says financial crisis, not property crisis. Everything dropped back to where it was. But look how quickly it recovered. Within a year, it's bounced back to half. And they were pretty intense times. And then we're up here. Coronavirus pandemic. Now everyone thinks the coronavirus pandemic, that's going to kill the world, businesses here, there. But look where we are. Look where we are. House prices, etc. Share prices, pretty much back where we are. House prices are higher than they've ever been. So if you think long term, you're going to have money. It's going to be there. You cannot time the market. You cannot assume this is going to happen. Now this is stocks, right? This is stocks. We're not talking property. Property almost follows a similar pattern, but it's not so aggressive. Up, down, up, down. Property, albeit less growth, from 10 to 7.5% on average, is much less volatile. It's something you can touch. It's there, tangible. I spoke about reinvesting dividends and compound interest. Maybe just a low index fund is for you. That is one of the best education funds you could probably come across. Don't put it in a bank. They're not going to pay you anything. Nothing. If you have funds, 40, 50, 60 grand sitting around, don't pay it off your mortgage. Buy another property. Let's say you've got 100 grand sitting around. Let's just assume you got 100 grand. Let's do this test. You got 100 grand. Let's firstly go to Rightmove, right? See what we can find. That's 100 grand. Let's go to Rightmove. Let's find our 100 grand. This is Peterborough. Type in 100 grand, any house. 2-bedroom apartment for sale, 99 grand. 2-bedroom ground floor flat for sale, 100. 2-bedroom masonette, 200. 100. 100. 1-bedroom flat. 2-bedroom flat, 100. 1-bedroom flat, 100. 100 grand. 100 grand. I wonder what they rent for. Ooh la la. Here's one we prepared earlier. 2-bedroom flat, 795. 700. 675. 800. 550. 775. So I've just done this as well, so we can prove it's out there. You got 100 grand. You then say to yourself, okay, the kids in 20 years' time, they need education. You might say to yourself, I'm going to put my 100 grand into property, not into stocks. I don't like stocks. I don't like a bit of paper. I want something that's tangible. So you then say to yourself, right, let's have a look. Thank you. Here's your 100 grand. On average, it goes up 7% per year. And then this is your compound interest working. 7% increase from 107. In year 3, it's 7% on 114. And then you get to year 10, it's 7% on 183. This is compound interest. Your monthly increase in value over 10 years, and it's risen sharply this year, even more. So you may get some nice little spikes. That gives you an average, 10 years is 120 months. it gives you an average increase of £1,639 per month. If you sell it, there's going to be capital gains and taxes and that type of stuff. However, you don't need to sell it. Remember the 50% rule. That's almost, you get 96 grand if you like, if you're splitting it in half with the equity. That's just in 10 years. In 20 years, let's do it. Let's do 20 years. Let's do 20 years because let's do 18 years because we are saving for our kids' education. We're not saving, actually. Get that out of your head. So we are going to take that one out, and then here, it should do that. Yeah, it should do that. All right, let's keep going. So this is year 10, 11, 12, 13, 14, 15, 16, 17, 18 years. There we go. The kid says, I'm going to uni, Mum, Dad. And then that equals that divided by 2. You have £167,000 available to spend on education should you need to. Now that is, divide that by 240 months, which is 20 years. That's an increase of £704 per month over 20 years. No, sorry, here. Sorry. We want this one. Okay. That's just the 50%. So this equals that divided by 240 months. That's an average increase of £1,600 per month onto your wealth while you sleep, bathe, save for retirement, whatever it is you want to do. This is one house that costs you 100 grand. That's if you decide to put all of 100 grand in it. Why would you? If you got 100 grand, go and buy 2 of these. Because then this here equals that times 2. £773,000 in value, which is 30 odd thousand pounds net. Remember, it's going to take you a long time to save that, all your life. And this is just your kids' education. This is if you do nothing else for the next 20 years. This is, and then you take the equity here, the additional equity. You can spend it on education if you want. If your kids end up doing something really great and paying for their own education, or they decide they want to be a plumber or whatever, you don't need so much. So then you reinvest that into other properties. Now, look at this one. Let's make this, say this is £1 million portfolio that you've now got and you've accumulated over 10 years. Over the next 10 years, that will now be worth almost £2 million. You take out 50% equity in 10 years' time, you're living on £1 million if you want to. You ain't saving for 20 grand a year. Screw that crap. Come on. I haven't even included the income. So let's say on those houses, we were getting about £600 a month on average, weren't we? You put your rents up by 5% a year. 5%, again, compound interest. 5% on 5% on 5%. In 10 years' time, that same property is rented for 600 will be rented for 886. Excuse me. Unless, of course, things like the pandemic come along and accelerate rents up. You're looking, 6% yield up to over 10% more than likely. On your £1 million property or properties, a collection of £5,000 a month is now going to be £3,000 a month. On top of the equity here on £1 million property, which is £16,000 a month. Growth over the next 10 years. See how investing, money, remember when I said the rich get richer, the poor get poorer. Why do the poor get poorer? Because here, look, rents, they go up. Here, where are the rents here? Rents, they go up. However, our properties go up. Here, rents go up, our income increases, or should I say, those with investments, your income goes up, those without, and this is not taking into account inflation. You're never going to have any money in the bank. Remember, I said you might be lucky to have 20% left. This is why credit cards are needed, because people outspend themselves within the first week. Oh man, I wish people would just get this into your head. Even if you're investing £100 a month, 50 quid a month, it's going to make a huge difference. Massive difference. Let's look here. What is this thing? Let's look here. Ready? Let's go on to inflation. So, I don't know. So let's say you're putting 100 quid a month, £1,200. All right? £1,200 a month, and you put it in 2019 in 1 year. In 1 year, on average, in inflation of 1.5%, that £1,200 is worth an extra £18 in 1 year. Just in 1 year, your money's growing. 2 years, an extra 50 quid. Let's go 5 years. Your money is worth an extra £160 in 5 years. Make sense? By the way, if there's anything here that you don't understand, you don't get, you've written down, put some questions in and we'll help answer. Or go to our website here, Wealth and Success Academy. Go to contact and find me. Put a message in here, or look, even give me a ring. There. Email us. Whatever you want to do. Dividends, we've covered that. How long to save £1 million? We've covered that. Decades, based on the minimum. What it would be worth when you retire. We covered that with the devaluation of money, inflation. How long will it last? Much, much less than what you think now. If you don't have money and you want to invest in property, the power of other people's money, OPM, is incredible, which is why it's used. There are so many dickheads out there who say, oh, but you didn't pay for it yourself out of your bank account. Using other people's money is getting a mortgage from a bank. You may have the bank of mum and dad. Use the bank of mum and dad if the bank of mum and dad is available, and invest it. Pay them back. It doesn't mean to say I'm taking it. Bank of mum and dad could be 1% interest. Hallelujah. You need to make sure that your investments are increasing in value more than what inflation is taking away. I.e., inflation at 3%, bank account at 1%, you're losing. Inflation at 3%, property at 7.5%, 7%, stocks and equities at 10%, you're winning. And with the power of compound interest, you'll win. It's so simple. Kids can do it. My kids know this. The power of compound interest. We haven't even spoken about starting a business. Build a business up. You can sell the business or build a business up. Get other people to work in it. Leverage people. Leverage time. Get an income from a business. Rent to rent is what I teach my students. One property brings them in 1,000. Some of them are bringing them in £2,000, £3,000 a month. That's like having a person, another job. And as they tell me, it pretty much runs itself. And I'm doing this for my students, this whole video, because some of them have, well, Sam has over 100 properties. Some have 20, 30, 40, 50. Some have 5. and have amassed this collection of money now. What do I do with it? Well, I want to help them realise that you don't actually need a big lump sum to get started. It's trickling in part of that income per month. Woof. Diversity. Make sure it's simple. I don't want you investing in 50 companies. 4 max. Ones that you love. Invest in stocks. Invest in property. I can't recommend coins. It's not long term. And I'm thinking long term. My passion is long term. Bonds you could do, but a smaller percentage. Sometimes bonds will be in favour, especially if bloody war breaks out or whatever it might be, or markets crash, bonds up. One goes up, one goes down. It's a bloody scale. But we're thinking long term. So bonds, maybe a 5% of whatever you put in. Then you've got something nice. Here, there. Don't put it into the bloody... what is that thing where people have thousands of money, the pools or whatever it is, and you win £25 every year? Mate, that is not good. That's lotto. That is not good. Can't remember what it's called. My granddad used to do it. Don't do it. I said, mate, the money you put in there, you could have 30, 40,000 now. Anyway. UK property has had a constant increase over time, average of 7.5%, doubles, which means it doubles on value every 9, 10 years, 11 years, 12 years, around about there. You must have an asset that increases in value and gives asset, property stocks. It could also be a business. We did the 100% test on Rightmove. You've got to take into account the cost of maintenance, repairs and inflation. The cost of renting when you look at fees. The cost of mortgages if you've got mortgages. Choose your property. Choose your area wisely. You want high yield. I would be looking in a high capital growth area, minimum 5.5% yield. In fact, if you mortgage it, the banks are going to want that anyway. Further out of town where equity, where capital increase is lower, but rents are higher, you'd be looking 7-8%. Good yield. And you can get more for your money if income is what you want to save for kids' education. And you'll also get that capital growth. It might be slightly lower. It might take 15 years to double in value. But hey, your cash flow is higher. Work out what you want. You want a nice mix of both when it comes to property. You could do some flips. You could do some development work for quick cash turnaround. Very volatile at the moment. Then reinvest your profits that you've made, your lump sums, not into paying off your mortgage, not into saving for my bloody rainy day. You've got to get in there and reinvest in something that's going to grow in value. Or you can inject equity, such as a flip, refurb, that type of thing. What? Wait until you're old? A pension isn't the only source of income you could rely on in retirement, which is what most people think it is. You may also receive money from property rentals or investments. Income, stocks and shares. Quality companies, no more than 4, I would recommend. It's up to you. A business, 2 or more. Or take on some part-time work is the alternative. Or use your savings. Either way, you're going to have to work. With the other ones, stocks and shares, you don't work, you pay taxes on your income, but there's no maintenance. No rentals, no tenants. Piece of paper's not tangible. Can't really see it, can't touch it, can't do anything with it. But hey, great return. See how you need to have a bit of both? A bit of both. Stocks and shares are not going to take any of your time, unless apart from the research up front. Zero, completely passive income. Property is not. You can manage it. Leverage out. Farm out the management and that type of stuff. No problem at all. You can do that. But just be aware of your costs as well, and make sure you include inflation in these. Cost of living. Cost that could fall. Mortgage payments. Because I'm paying off my mortgage. Pension contributions. Don't have to pay anymore. You're not working anymore. Commuting costs. I'm not having to travel anymore. I'm at home enjoying my mortgage-free, free of the shackles, debt-free house. Can't go anywhere. My car's bust. Can't afford to fix it. Paint's falling off the walls. I need a new kitchen, but who cares? I own it. Costs that could increase. Healthcare as we get older. Insurance premiums as we get older. Lifestyle costs. Little holiday. Maybe you can't go. Socialising. Want to come out for lunch? Go. Can't afford it. Hobbies. Costs a lot these days, doesn't it? I remember when it only cost me a tenner to go bowling. It was 40 years ago, Georgie. I know, but the cheek of it's 120 quid these days. I can't afford that. Not on what I put away. This is the cost of expenditure 2016 to 2018 for year ending. Household expenditure, including rent, these type of things. The average in the UK is £550 per month. Per week. North East is the cheapest, Wales next, so on and so forth. London's obviously the cheapest. Edging up like the South East, the commuter belt, up to £700 per week, £2,800 per month. That is your after-tax pay. How much money do you have to earn just to cover your expenditure? If you've got a mortgage, it will probably may cost more. Rents may cost more than mortgage. It depends. This will not go down either. This will only go up with inflation. If it doubles over the next 10 years, can you afford £1,400 a month, a week, just to live, just to get by? There is no saving for a rainy day. Retired single person. What is an essential lifestyle? I've got my bread, I've got my milk, I'm sitting at home, I watch my TV. I live. No, I don't. I survive. What's comfortable? What's a comfortable lifestyle? Most of us probably have a partner of some way, shape or form when we lived them, and we're a couple when we're retired. In many cases, not everyone. But that's going to cost you £18,000. Comfortable lifetime, £26,000. I'm assuming this is mortgage is all paid off, sitting in your house, shackled debt free. For a luxury lifestyle, I'm assuming this is going on a holiday or two a year. You have a car that you can drive. It's not broken down. You can maintain your house. 41 grand a year. This is today. In 10 years' time, what's that going to be? If property's doubling, this is going to cost you £82,000. What you're putting away at the moment is going to be £20,000 a year that you can get, or £30,000 or £40,000. You ain't going to have luxury. You'll be lucky to have essential. I know it's hard and it hits home, but you can start today. Get stuffed away from here, move along, start looking into index or whatever, or getting shares, or getting into property, some way, shape or form. No matter what type of lifestyle you want to lead when you retire, your options will be limited by the size of your pension pot. Because a pot is all in case one thing. The larger the pot, the more you can pay out. Oh, well, okay, my pot's a bit bigger. Stuff one pot. You want a pension, you want your stocks, your shares, you want your property, your business, multiple streams of income. Look how much money you've got to save to get 20 grand a year. For 20 years, 285 grand. 30 grand a year. Look, over $500,000 to get 40 grand a year for 20 years. I know for a fact I could not live on 40 grand a year. Probably why I do what I do. Married. 2 kids. No, income drawdown. Taking out money for your pension installments is a common way to receive retirement income, whether that's quarterly, monthly, or whatever it is. 25% of your withdrawals are tax-free. Not fax-free, tax-free. Above that, you will be taxed. So if something goes wrong with your house or whatever, you need some money out, you're going to be taxed on that. That rainy day that you save for, the government's going to tax you on it. Summary. We're coming to a close. It's a long one. I gave a lot more than what I thought I was going to give. Apologies for that if you're asleep. But hey, hallelujah for you if you're that one person who's making changes now. So, savings for the future, or saving for the future, will not create the lifestyle that you think you are going to have. It definitely will not copy or look anything like the lifestyle you have today. You need multiple streams of income, multiple assets that increase in value and give cash flow. Business, property, stock, shares, whatever it might be. Remember, plan beyond retirement, not the horizon, i.e., I think I'm going to die when I'm 70. Plan beyond that. You will have more than enough and leave it as a legacy. Your legacy will benefit. If you want to give it to charity at the end, much like Warren Buffett, all of his Hathaway shares he's given to charity, billions of pounds worth. If that's what you want to do, do it. Stick it in your will. But just make sure you and those around you are okay until that day. You may die before your spouse. Make sure they're okay. Look after them. Money devalues every day. What you could buy for £1 10 years ago, you cannot buy now. Stay ahead with your investments. The growth must be ahead of the inflation. And finally, you must invest in something that increases in value and returns a positive cash flow. Hands off passive income. Property is not completely hands off. Stocks and shares are. Bonds are. A business is not. Until you start to leverage other people, sit back, do your bit. Now, I hope this has helped you today. Any questions, go onto our website. As I've said, have a look. Contact me. Jimmy's my business partner. The easiest way into property, by the way, as I've proven to all of my wonderful students, is to get cash flow first and then learn something like this and start to reinvest it. The last thing I will say is, if you work for money, you will never ever be wealthy. If you get money working for you, employ money, you will make money for beyond your life while you sleep, pray or play. So the rest is up to you. I wish you all the best, and I wish you all the wealth and happiness that life can offer and every single miracle that you could possibly think of. Take care.